Hi everyone, welcome to Chapter 14. For this week we're going to be looking at Chapter 14 and 15, which is going to be looking at the role of banks in the financial institution. You'll notice that money is the most important asset that people are willing to accept. An asset is anything that's of value that's owned by a person or a firm. When you look at money, money is anything that will be accepted to exchange goods and services. There's two types of money. I should do this. The functions of money. There's basically four main functions of money. Money is used as a medium of exchange, where it is exchanging one good and service for another. Money is used as a unit of account, where we are able to measure things based off the prices that's being charged. Money is also a store of value, and money allows people to defer consumption to a later date because of that store of value. And the last one is standard of deferred payment. And when we look at standard of deferred payment, you'll look at how money will facilitate exchanges across time. And when we look at the value of the future, it'll be predictable. Now, when we look at money, you notice that money is like a commodity money. It really holds no value. The only reason it has value is the government decrees value on the money that's been established. We notice that fiat money, now commodity money has a value as a marketable value, whereas fiat money is a little bit different. It's looking at the money that's established in our economy. And fiat money has some advantages because the government decrees that money and gives it the advantages and disadvantages of our economy. Now, if you look at Apple, why didn't Apple want to accept cash? Like example, a woman in California went to an Apple store, tried to buy a $600 iPad. Apple refused the sale. It wanted to keep track of people buying multiple iPads to resell it, so it was only accepting credit or debit cards. Can Apple do this legally? Yeah. Firms are not obligated to accept currency as payment, although it seems very strange. Debts are a different story. But when you look at it, they have to accept a form of payment, and they're the store, so if they want to make people upset, they're more than welcome to do so, which was a very big challenge in our economy. In their store. How do we measure money? We measure money through M1 and M2. M1 is going to be the most liquid of assets for an economy. M1 is looking at cash, currency, and checking accounts. So if you were in a room with someone, they could give you money from their checking account, or they could give you cash or a traveler's check, and it will count as money. The term that you'd like to focus on with this is looking at liquidity. Liquidity is ease at which things can be converted to cash. Now, if we look at M1, you got about 2.5 billion. If you look at M2, you got about 10.7 billion. You notice that M2 is much larger than M1 because M2 includes what? M1 right here. That's the key. So that's some of the concepts in that chapter. Let me get the remaining parts of this chapter up. Now, main concept that we look at is with credit and debit cards. When you look at credit cards, you notice that's a convenient way to pay for short-term loans, basically, from a bank. And you use credit cards to conduct transactions, whereas debit cards are a little bit different. It takes money directly out of your account. Now, how do banks create money? And that's the key. Banks create money from the money that you put in a bank. Banks use your money to lend money out. So banks are very cautious on what they're lending out because they have to ensure that they have enough money in their bank to lend out. And if they do, they can create a lot of financial issues in our economy. Here's an example of a balance sheet of a typical bank. You notice we have the amount of deposits right here. You have reserves, loans, but you notice that assets will equal liability. So a bank is dealing with this daily. They're trying to figure out the best amount to actually loan out in their bank, but they have a lot of liabilities. Liabilities are things that a bank owes, where assets are things that banks own. So those are some concepts that we're going to see in these chapters, but I look forward to your effort.